Welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 8, the problems in Group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing is easily remedied by watching someone else work out the problem. However, if you don't understand the concepts, that's a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And as a quick aside, just like all of the rest of the problems or exercises in this chapter, we're talking about long-term assets. So we're talking about concepts interrelated with other concepts, meaning if you talk about long-term assets, you have to talk about, you have to consider accumulated depreciation. So you need to know how to depreciate your assets. I'm not going to go over and cover the theory or discuss how I'm calculating the depreciation methods, okay, that type of thing. What is new to this chapter in your long-term assets is figuring out how much the value of the asset is, and how to put it on your books, how to take it off your books, how to record your gain and loss. So I'm not going to go over old concepts and theories. That's stuff that you should have learned in Math for Business and Finance or from a previous chapter in financial accounting. So I'm going to just skip over that stuff. If you get lost in that aspect, then you'll have to go back and watch those theory videos. And if it comes to the new theory, again, go back and rewatch the theory videos, and do the other homework problems that pertain to those particular concepts. And the reason why I'm even bringing that up is because I took a quick look at this problem here, which is the one we're working on. And what it wants us to do is to create a schedule of depreciation for each of the three depreciation methods. Right? Well, I'm not going to create the depreciation schedules. You can look at those in the solution manual to see how that schedule of depreciation is created, what it looks like. I mean, I will go over the math here for calculating depreciation, because it's interrelated to what the cost of the asset is, okay? But I'm not going to go spending 20 minutes creating these depreciation schedules when you can take a look at them and see what they look like in the solution manual. So with that said, it says here, on January 4th, Sunbelt Systems paid $287,700 for equipment used in manufacturing automotive supplies. In addition to the basic purchase, the company paid $2,800 transportation costs, $800 for insurance while in transit, $25,800 in sales tax, and $2,900 for the special platform on which the equipment is in the plant. Excuse me. Sunbelt Systems Management estimates that the equipment will remain in service for 5 years and have a residual value of $40,000. Okay, so will be in service for 5 years, residual value of $40,000. The equipment will produce 60,000 units the first year, with annual production increasing by 5,000 units during each of the next 4 years. For example, 55,000 in year 2, 50,000 in year 3, and so on, for a total of 250,000 units. And so that has to do with units of production, right? In trying to decide which depreciation method to use, Sunbelt Systems requested a depreciation schedule for each of 3 depreciation methods: straight line, units of production, and double declining balance. Right? So, number 1, for each depreciation method, prepare a schedule showing asset cost, depreciation expense, accumulated depreciation, and asset book value for each year for the asset's life. For the units of production method, round depreciation per unit to 3 decimal places. pay attention to that. It's telling you how many decimal places. If you round only to 2, or you're lazy and don't round, or you round out to 6 or 7 places, you just leave whatever answer is in the calculator, because most calculators take out the 10 places, you're going to get the answer wrong. Right? They want you to round to 3 decimal places. Right? So number 2, Sunbelt prepares financial statements using the depreciation method that reports the highest income in the early years of asset use. For income tax purposes, the company uses the depreciation method that minimizes income taxes in the early years. Consider the first year Sunbelt system uses the equipment. Identify the depreciation method that meets Sunbelt system's objectives, assuming that income tax authorities permit the use of any method. Okay, so for that, and I'll actually cover that when we actually do it. All right, and then it says here, show how Sunbelt would report equipment on the balance sheet for each depreciation method. All right, so the first thing that we're going to have to do is we're going to, for each depreciation method, prepare a schedule, right? So the issue becomes, what is our asset cost? It says they paid $287,700, okay? That is not your asset cost. If you go back and you watch the 30 videos, you'll realize that any cost associated with the asset up until you put it into service, as it gets capitalized, it becomes part of the asset cost. So it has, in addition to the basic purchase price, the company paid $2,800 for transportation costs, $800 for insurance while in transit, $25,800 for sales tax, and $2,900 for a special platform. Okay. When we add all of those up, we end up with $0.02. We end up with $320,000. So our asset cost is going to be $320,000. Right? That is what is going to be shown on our balance sheet. Right? The equipment will be having a book value of $320,000. So now we need to calculate and create a depreciation schedule for each of the 3 methods, right? So the first, we're going to use straight line depreciation. So it says here, management estimates that the equipment will remain in service for 5 years and have a residual value of $40,000. So $320,000 less $40,000 is $280,000, and we divide that by 5, and that gives us $56,000 for each year. So for straight line, each year is going to be $56,000. Okay. Now, as I said, I'm not going to recreate the depreciation schedule. Okay. You can look at the depreciation schedule in the solution manual, right? And in there, you'll see the asset cost. The depreciation rate being straight line is 1/5 each year, right? Yeah, 5 years, right? So, and the depreciable cost is $280,000. That's the $320 minus the $40,000. So the depreciation expense each year is $56,000. And of course, the accumulated depreciation goes up by the 56, and the book value goes down by the 56 until you hit the residual value of $40,000. So I'm not going to recreate that schedule. You can, like I said, look at that and go back and watch the 30 videos if you have to on creating the schedules of depreciation. All right, so that's for straight line. Now for units of production, all right, we still have 320,000 less the 40,000 of residual value, which gives us 280,000. Okay, but for the units of production, it tells us, okay, so we're here. The equipment will produce 60,000 in the first year, with annual production decreasing by 5,000 during the next 4 years. 55,000 in year 2, 50,000 in year 3, so on and so forth, for a total of 250,000 units. So if my value is 280,000 and I divide by the number of units of 250,000, that gives me $1.12 per unit, right? So now, if you look at the depreciation schedule, okay, that's in the solution manual, and I'll do year 1 here, okay, it tells us that for year 1, so units of production is $1.12 per unit. So for year 1, it's telling us that we had 60,000. It's going to be produce 60,000 units. So we multiply 60,000 by $1.12, and that's going to give us $67,200 for our accumulated depreciation for year 1. In year 2, we're using it 5,000 units less. In other words, we're decreasing the units of production by 5,000, but we still multiply by the $1.12, and that gives us 61.6. All right, and then year 3, 50,000 times 112 gives us 56,000. Year 4 is 45,000 times 112 gives us 50,400. And year 5 is 40,000 times 112 is 44,800. Now, if you add it up, these units of production for all of these years, you'll find out that you have 250,000 units, which is what we base it upon here. And so that means your book value, you can see the accumulated depreciation increasing each year by adding 1 year to the next, and your book value goes down by that amount of the depreciation, so that your book value at the end of year 5 is the $40,000. Okay, so pay attention to that on the schedule of depreciation. Now, double declining balance. Okay. All right. Okay, so double declining balance. We're depreciating it for 5 years, right? So each year is one year out of the 5, and we're multiplying it by 2 because it's we're doing double declining balance. All right. So we're multiplying that by 2 in order to get a factor of 0.4. So each year, right? Each year is 1/5 of the useful life times the double declining balance gives us this factor. Okay. So for year 1, we start out with the full 320,000. Okay. And we multiply it by the factor of 0.4. Right, and that gives us our depreciation expense for the year of 128,000. Right. In year 2, if you look at the schedule of depreciation in the solution, it says the book value is 320,000. less the accumulated depreciation of 128,000 gives us a book value at the end of year one of 192,000. Okay, so that's the figure we're going to use for year two, 192,000 times 0.4, right? Which ends up being 76,800. And of course, since that's our depreciation expense, we're at, or our accumulated depreciation goes up, 128 plus 76.8 means our book value ends up being 115.2, and that's the figure we're going to use for year three, right? 115,200 times 0.4. Now I'm not going to keep on going through the math, but realize that well, maybe I just should. All right, so that ends up being 46,080. And so our book value at the end of year three is 69,120. So for year four, 69,000, boy, for whatever reason, 69,120 times 0.4 gives me 27,648, and that means my book value at the end of year four is 41,472. Now remember, when you're doing double declining balance, all right, what you're doing is as you're using that factor and you're booking the depreciation expense, you're booking it at an accelerated rate, okay? And so you just keep on booking that expense until you hit the residual value. Right now, we're at 41,000 as the book value. Well, if we want our book value to be 40,000, okay, the difference between the two is $1,472 for year five. We don't do the double declining balance on this 41,472 because if we did, that would be below our, that amount would be below our residual value. 41,472 times 0.4 means we would have 41,472 times 0.4 means we would have an additional $16,588 of depreciation expense, right? Well, if we take that 16,000 from the 41, that's going to put us below our $40,000 residual value, and we don't want that. So we can only take the difference between our book value at that time and the $40,000 of residual value that we want, which ends up being the 1472 for our depreciation. Okay, so that's it for the double declining balance. Again, if you didn't get that, go back and watch the theory videos for financial accounting. All right, and if necessary, go and watch the videos in the Math for Business and Finance section. In order to learn how to do the the various depreciation methods. Okay, so that was requirement one, calculating the different depreciation methods and creating a schedule. Right? Excuse me. So number two here says prepare financial statements using the depreciation method that reports the highest income in their early years of asset use. Right? For income tax purposes, the company uses depreciation method that minimizes income taxes in the early years. Consider the first year. Sunbelt System uses the equipment, identify the depreciation method that meets Sunbelt's objectives, assuming that the income tax authority permits the use of any method. All right. So I'm going to come back to number two because the explanation of it is relevant to how we're showing the different depreciation methods on the balance sheet for on the balance sheet for each depreciation method. All right. So let's see here. Our cost, right, or let's just call it equipment. Then we would have less accumulated depreciation. Okay. And of course, excuse me, sorry, that would give us a book value for our straight line, right? So for straight line, our equipment, well, actually, our equipment cost is going to be $320,000. That's what it's going to look like. Okay. And in the first year, we're going to have $56,000 of accumulated depreciation. So our book value is going to be $264,000. Okay. So that's what it would look like on our balance sheet. Okay. Now, again, if you're using single step, I could have put the 264,000 here and called this book value, but it's better to use the multi-step since obviously we're going to have cash here, accounts receivable, inventory, so on and so forth, and those numbers are going to be here, right? And so remember, what we're doing here is, in order to get the book value, we're doing a mathematical calculation. When you're using multi-step, you always go one column to the left in order to do the mathematical calculation, all right? And you put that math in the right-hand column. And so this way, if I have to have my total assets here, right, I'm looking at this column here, right? I'd have this amount right here, right? So, you should already know this. This should be second nature. So I'm not going to recreate everything exactly here, all right? So I just gave an example of how you would do the straight line, all right? But I'm going to call this column straight line, and that's 264,000 for the book value. Now for this column here, we're going to have units of production, okay? And I'm going to use this column for a double declining balance, right? So we would have 320,000 for all three of them, of course. But our accumulated depreciation at the end of the first year for the units of production is going to be $67,200, okay? And of course, that ends up giving us a book value of $252,800. And for our double declining balance, it's $128,000 in our first year, which means our book value is $192,000. Okay, so if you can imagine, this is number 3. All right, we're just at number 3, where we would report the equipment on the balance sheet for each depreciation method. Okay, so basically you would end up having 3 financial statements here, but to make things a little bit easier to see what it looks like, that is all the information and data together. Now I said I'd come back to number 2, and the reason why is because this way I can look at this information and, excuse me, be able to figure out what I need to do for number 2. It says prepare financial statements using the depreciation method that reports the highest income in the early years of asset use. Okay, so remember we're talking about financial statements. Then it says for income tax purposes. Okay, remember when it comes to accounting for a business, and for the vast majority of the year, you're going to be considering financial accounting, okay, which is different from accounting for taxes. Okay, when you're doing taxes, all right, and you're going to depreciate an asset, you have to use the maker system. Okay, You don't have any other choice. For financial accounting, you can choose straight line, units of production, double declining balance, weighted average, or make one up for yourself, okay? Because you're trying to represent your financials in its best light. But for tax purposes, everything has to be done using the maker system, okay? So with that said, it's telling you now that we have financial and we have income tax, but it tells us here, assume that the income tax authorities permit the use of any method. And so what we're looking at here is it's basically trying to say, okay, which method best defines our objective, all right? And our objective here is to report the highest income in their early years of asset use. Well, the highest income is what? You know, income is on our income statement, right? And we have revenues less expenses. Gives us our profit and loss. Okay. You know, this is all concept. This is all theory. This is all what's going on in my head that I know and I've learned as the concept. And you have to be able to think about it in this perspective. You know, when I'm sitting here and I'm looking at highest income, that tells me, you know, immediately I want the lowest expense, right? Why? If you have to plug in the numbers, that's why I'm going over this. Here's my income statement. On your income statement, you have revenues less expenses, give you your profit or loss. Well, if I have revenues of $100,000, I have expenses of $75,000, that gives me a profit or loss of $25,000. If I had expenses of only, say, $35,000, then my profit or loss would be $65,000, right? Well, notice that as my expenses go down from 75 to 35, my profit or loss goes up, right? Because why? I have the same amount of revenue, but I'm not, you know, I have less expenses to deduct from the revenue. So what I'm doing is, if I want the highest income, I want to use the lowest one for expenses. And in this case here, that would be the straight line method because it produces the lowest expense in the first year. Okay. Now on the opposite end, all right, so it says here for income tax purposes, the company uses depreciation method that minimizes taxes in the early years. Excuse me. So what does that mean? So we're minimizing taxes, right? Well, for income tax purposes, right? What do we want? You know, we want the least amount of profit, right? Because why? We're being taxed on our profit, right? So if I want the least amount of profit, that means, let's go up here, back here. That means I want the highest expense in that first year, which means I'm going to want to be using double declining balance. Why? Because if I have 100,000 here, if my revenues are 100,000 and I have 85,000 for expenses, that means I'm only going to have 15,000 in profit. I'm going to pay the least amount of taxes because I only have 15,000 versus the 65 or the 25. So the greater my expenses, the lower my profit or loss, and the lower my profit or loss means I have the least amount of taxes. Right? So if I'm considering it from an income tax perspective, I want to have the depreciation method that produces the highest amount of expense. So let's see here. So for prepare financial statements using the depreciation method that reports the highest income in the early years, right? We determine that to be straight line. For income tax purposes, we want to reduce our profit. So we want to use the method that produces the least amount of profit, which is double declining balance. And so that's, that's the solution for step number 2. Okay, so I know this was pretty involved. Excuse me. Um, Pause the video, go back and watch it again. But I think I covered everything for this that's necessary for this particular problem as far as concept-wise is concerned. If you're not getting something, go back and watch one of the previous theory videos. And if you still don't understand something, feel free to call and contact either email or telephone an instructor, and we'll help you go over it. Okay.